Good morning, everyone. My name is Sean Barnes. I'm with Williams Keepers LLC, and it's my pleasure today to welcome you to our special BOSS seminar that talks about the CARES Act and the Family First Act and how you can use those two resources to help you navigate through the COVID-19 pandemic and its ramifications on businesses and individuals who own those businesses. A few housekeeping items before we get started. I would like to let you know that all of our participants are on mute today, and we would like to keep it that way through the presentation if possible. And if you would like to submit questions to our presenters today, you can do that using the chat feature or the questions and answer feature that's located in your status bar of the Zoom meeting platform. The folks who are going to talk to you today are two of my very esteemed colleagues. Mark Gingrich is a tax partner in WK's Columbia office, and Jeremy Morris is a tax partner in our Jefferson City office. Both of these gentlemen have been helping to do a lot of extensive research on behalf of our staff for our clients, and have had pretty extensive involvement in helping us respond to many questions that we've gotten in our office, and that those questions kind of serve as the basis for this presentation today. We'll let you know too that we will have the slides from this presentation and a recording of the presentation available after this event sometime later this afternoon on our website. I would also like to remind you that you could go to williamskeepers.com and register to receive daily updates and email updates from us as they're posted about the COVID-19 pandemic business ramifications, as well as any other email notifications that we send out to our clients as part of regular communication to them. And again, you can do that at williamskeepers.com. So with that, I'm going to turn it over to Jeremy, who's going to lead off our presentation today. And once again, on behalf of all the partners and associates at WK, we certainly appreciate your attendance today and hope this is mutually beneficial for you. So Jeremy, you want to lead us off?
Yeah, thank you, Sean. Appreciate it. Appreciate everyone's attendance today. Sean said, my name is Jeremy Morris. Mark Gingrich will be joining me in just a moment. Happy to have you guys here today to discuss this, maybe not about the circumstances themselves. At the outset, what we hope to accomplish today is, we want to take this COVID-19, all of these issues surrounding it, and focus on the business challenges associated with it, questions we've been receiving, and some, potential tools that business owners have to deal with these. I would say at the outset, we're focusing on this because that's our lane, so to speak. Mark and I are both accountants. We are not doctors. We don't mean to diminish the health impact associated with this. Obviously, that is the main concern. Our presentation today will be focused on the business side of it because that's the world that we are living in and working in. But in no way, take any of that to mean that we are in any way diminishing the health concerns associated with this. So having said that, kind of as a lead off, this is, at least in my lifetime, a relatively unprecedented level of disruption as it relates to businesses, which then impacts business owners, employees, and as we've talked about, the community at large. And so to that end, what we hope to do with this presentation today is begin with a few of the tools that were provided to us in two of these relief acts. At least that's mostly what we're going to focus on. Some of these may come outside of that, but the CARES Act and the Families First Act. And so what we want to do is take a look at those tools, cover them generally, and then take a look at a handful of situations, 3 specific situations that we're seeing business owners deal with, and figure out maybe or discuss how those tools can be applied to those specific situations. Now, you'll notice at the outset that there will be we're only going to discuss a handful of these items. There are other things, and as these slides are made available, some of the tools that we probably won't talk about today relate to items that are really impactful to all business owners. They don't necessarily involve a decision point. The ones that we'll be discussing today either are ones that there is some choice between alternatives, or they are implied and there's some type of cost benefit analysis associated with them. again, there's some decision point. But there are other tools that we'll discuss that may be more broad, have more broad applicability, so to speak. So again, we're going to discuss some of the tools, some of the situations, and then open this thing up to Q&A. Again, as part of the disruption, I would say in advance, consistent with that, if any of our kids bust into this presentation, we would like to apologize in advance for that, but we will continue to forge ahead. So moving on, all right, to the toolkit to solve business challenges. Really, the Families First Act, let's start with that, because that's the first piece of, that was the first bill that was passed associated with this. And really the main focus as it relates to relief associated with this act, it was an act to provide, it required business owners to provide leave for their associates for COVID-related leave. There's really two pieces of this. The first of which is sick leave. So and Mark will talk in a second about the Family Medical Leave Act, the expansion of it. But this was to provide emergency sick leave or leave for your employees associated with COVID-related leave. And for those that provide that, it provided a tax credit mechanism to reimburse the employers for providing that leave. Okay? So that the employers will not be out of pocket cash for the amount of leave and the cost of the leave that they're required to provide under this act. So this is applicable to employers with fewer than 500 employees. And what it requires is up to 80 hours of sick leave to be provided to employees. For again, there's really six, it says six, but really 5 reasons associated with COVID-19. We say requires up to 80 hours because if you have full-time employees, it requires you to pay them up to 80 hours. If you have part-time employees, you're required to provide the leave up to the amount of their normal hours. And as I mentioned at the outset, there are tax credits available to offset the amount of leave paid under this provision. So the government is reimbursing employers for providing that. So the credit amount falls into one of two different buckets, so to speak, or one of two different calculations. If the issue is related to the employee and that's what's causing the leave. So for example, the employee is personally quarantined and or experiencing symptoms related to COVID-19, or they're seeking a medical diagnosis associated with it, the employer is required to provide up to 80 hours, again, for full-time employees of sick leave at 100% of that employee's normal pay, up to a maximum of $511 a day. If the problem that is requiring the leave is more closely associated with the employee's family, so for example, that employee is caring for someone who's under quarantine, or to care for a son or daughter whose school or daycare is closed due to COVID-19. The employer is only required to pay them up to 80 hours, again, if it's full-time, up to 80 hours, for 2/3 of the employee's normal pay, and that maxes out at $200 per day. And again, if you make payments under this, the amount of the tax credit you receive is also limited to the maximums here on these slides. So $511 per day for reasons 1 through 3, for example, if you were to look at the act, and for reasons 4, 5, and 6, it's maxed out. The credits are also maxed out at $200 a day. So again, if a business strictly adheres and does no more than what is required of them under the bill for this emergency sick leave, they won't have any out-of-pocket cost. Obviously, an employer doesn't have to be, this just really sets the floor. The employer can pay up to 100% of their pay beyond these maximums, but they will not be able to be reimbursed for the credit in an amount greater than what's listed on this slide. So that's the emergency sick leave. With that, then I'll turn it over to Mark to discuss the FMLA provisions in this bill.
Thanks, Jeremy. So the companion to the emergency sick leave is the concept of expanded FMLA. And Jeremy well described 5 or 6, depending on how we count, situations in which there would be 80 hours of paid sick leave on an emergency basis. The act went further than that and provided for paid leave beyond the 2 weeks or 80 hours, and the paid leave applies only in one of the situations. So we're only dealing with a situation that Jeremy and my family are both wrestling with, and that is the kids are out of school. And if both parents are working, some of them might need to be either teleworking or not working. And so in my personal situation, I am teleworking, but in other families or other jobs, that may not be possible. And so if you have employees, if you are an employer, again, with fewer than 500 employees, and you have an employee who is unable to do their job remotely, and that employee is staying at home to take care of a child who is out of school or out of daycare because of a COVID-19 related closure, then there's an additional 10 weeks of paid leave available to that employee, capped at $200 a day and payable in an amount of 2/3 of their normal salary. Again, like the emergency sick leave provisions that Jeremy just described, if an individual is paid at 100% of their normal salary for FMLA, then in that situation, they would get paid the normal amount under the existing FMLA policy, but the tax credit to subsidize the employer would be limited to 2/3 of the normal salary, but capped at $200 a day. And so the tax credits are intended to cover the minimum requirement. There are no extra credit points for doing more as an employer. The government will subsidize to 2/3. And both of these provisions are applicable to wages paid in the last 5 days and going forward. And so with the two working together, there's an opportunity that someone who is out for one of these items could potentially have 12 weeks of paid at some level leave for the period following an event, if it's an FMLA event that triggers the sick leave as well. Again, the only FMLA leave trigger being that your kids are out of work and you cannot telework. I'm going to shift gears if we could, and we're going to talk about a provision that is out there, or an idea that's out there that is not in either of these bills. So it's a little bit of an outlier. So as we think about options that a business owner has, we think about some of these tax credits. We're going to talk about some other incentive provisions, but we don't want to lose sight of some of the normal business concepts that someone might be able to apply to help to ease cash flow during what we all hope will be a temporary disruption in the circle of payables and receivables. So the Federal Reserve came out with a memo towards the tail end of March and has encouraged banking partners, many of whom are on this call with us here, to be flexible with borrowers, and has provided for some flexibility in accounting the regulatory challenges that would normally come along with loan modifications. And so the idea here is that, you'll see it published, and it's good advice. We don't want anybody to just stop paying their bills. But if you can work with people to whom money is owed and do it in a proactive way, there are opportunities to, for example, flip a loan from principal and interest to interest only for some limited period of time. And working with partner banks is something that the Federal Reserve has encouraged. So, as Jeremy framed our discussion for this session here today, we're not going to be, this is one of the ideas that's out there for everybody, and we've organized most of those to the tail end of the presentation. But this is a big enough item that we wanted to give it special attention towards the beginning to make sure that people are preparing their balance sheets for the rockiness and using the tools available to them to to help cushion their balance sheet to deal with timing issues in the collection of their own receivables. So Jeremy, let me kick it back to you, and we'll dive right back into the regulatory provisions and tackle some of the things that are in the CARES Act.
Okay. Yeah, thank you, Mark. This next item, so again, we'll kind of be switching gears in from Family First Act to CARES Act. This was the most recent law that was passed relative to COVID-19 relief. And the first item that we want to look at is probably the item that has received most of the attention, at least as it relates to business owners within the last week, and that's this Paycheck Protection Program. And again, also looking at the questions we're getting, now and then, throughout this last week, this has been the item that's probably caused the most questions. So let's take a look at it at a high level. And this is also going to play a pretty important part as we look at some of the situations going forward. So Paycheck Protection Program through the SBA applies to businesses with 500 or fewer employees. And at its very simplest, again, there is some questions on this and a lot of unknowns, at least as it relates to a couple of different items. But at its most simple, the point of this is to provide proceeds to businesses, predominantly to pay their employees and to cover other expenses that don't stop, even if business is being disrupted. And assuming you pay you use it for those proper reasons, the loan actually becomes forgivable or forgiven and becomes a grant. So the way that this works is that businesses apply for a loan equal to 2.5 times the business's average monthly payroll cost. Again, per the bill, it was for the prior 12 months. I think what we're seeing in the actual application process, most banks are requiring it for 2019. So you take a look at your average monthly payroll for 2019, you multiply that by 2.5, and that calculates your maximum loan amount. And again, the overall ceiling on this is $10 million. What you can do then is within an 8-week period after the origination of the loan, any amounts of loan proceeds that you expend on payroll cost, mortgage interest, rent, or utilities, those are forgiven. And that cancellation of debt is also not taxable income to you. Any amounts that are not so expended, or those become loans then that have 2-year terms and an interest rate of 1% is what's been specified by SBA. Okay. So again, 2.5 times average monthly payroll for the prior year. That gets you your loan amount. You spend it on the right things. It is generally then forgiven. However, there are other provisions. Even if you spend every dollar of the loan on appropriate expenses within the 8-week period, you can, however, lose out on some loan forgiveness if one of two things happens. Either one, the average number of employees that you have, and this is a full-time equivalent calculation. So the average number of full-time equivalent employees during the 8-week period is less than your average full-time equivalent employees during the baseline, which generally speaking is the beginning of 2019. Okay. If there is a reduction in employees, the amount of the loan forgiveness is also reduced pro rata. So if you had 100 employees during the baseline, and during the 8-week covered period where you have the loan and are spending the loan proceeds, if during that period, let's say your 100 employees, you've had to let some people go and it's now 90, the maximum amount of loan forgiveness that you can get is 90% of that loan, okay? Because your employment is only 90% of what it was during the baseline period. That's one way. In addition to that, if you maintain the number of employees, or even if you don't, if you also, or in addition, reduce the wages of employees significantly, okay, by more than 25%, to the extent you've reduced wages of any employee by more than 25% over what they were during their baseline period, that also results in a reduction in loan forgiveness, okay? So again, there's really three things you have to do. You have to spend the money during the 8 weeks on the required expenses. You have to maintain full employment from an FTE or full-time equivalent employee standpoint as compared to the baseline. And you also have to keep wages relatively similar to where they were before. So again, if headcount decreases or the average wage or the wage of an employee significantly decreases, both of those will cause you to lose out on some of the loan forgiveness. Now, there is also one sort of do-over provision or one sort of safety net for those businesses that have either reduced wages or laid people off after February 15th of 2020. If you restore those wages and employees by June 30th, 2020, you are not in any way punished for that temporary unemployment or that temporary reduction in wages. So if you get everything reset by June 30th, 2020, and you pay the proper amount, you use all of the loan proceeds for the right reasons, you can still get full loan forgiveness, even if you had less than full employment during that period of time that you had the loan. Now, as we'll discuss in a little bit, having less than full employment during the loan may make loan forgiveness more difficult for other reasons, but we just wanted you to be aware that you do have this do-over provision, this rehire provision, may be a better way of describing it. So that's a Paycheck Protection Program. I see, as I was talking, a lot of questions come in on that. So again, we'll get to those towards the end of the presentation. And with that, I'll turn it back over to Mark to discuss some of the other tools in the CARES Act.
Jeremy just sent me a note saying that I was muted. So all the good stuff that I just said is just for my own benefit. Thanks to Jeremy for a good summary of the Paycheck Protection Program. Over the past 3 or 4 days, we've had a lot of activity in this, including the application process going live on Friday, regulations coming out and forms coming out at 5 o'clock on Thursday. A lot of the folks on this call probably have already made applications, and some of you hopefully successfully have successfully applied to the program. So again, we'll touch on a lot of the questions here at the tail end of the program after we've presented some of the case studies as well. So I'd like to talk about an alternative to the PPP. So this is for businesses who didn't apply for 7A. And sorry, when I say 7A, that's an SBA loan provision that is the same as the Paycheck Protection Program. So this next incentive applies for people who could not apply. Perhaps they had too many employees. Perhaps they didn't know about it, but hopefully that's no one here on this call. And so if for some reason a person missed out on the PPP, there is an option to basically take out a short-term loan from the government by, instead of remitting employment taxes ratably throughout the 2020 year, those taxes can be remitted instead at the end of 2021 and the end of 2022. But the important point on this slide is the last one, and that is this is an alternative, not a supplement to the PPP program, which gives businesses the opportunity to turn a loan into a grant. And so we conceptually think of the PPP for eligible employers as superior to this provision of the CARES Act. Sorry, let me toss it back to Jeremy to tackle the enhanced unemployment benefits, which provide another arrow in our quiver.
Yeah, thank you, Mark. So something else that has received attention, again, is the expansion in those situations where, you either from are required to, shut your doors, or you've had to lay people off, enhanced benefits under unemployment provisions. as it relates to provisions to employees. So under the CARES Act, what it did is it provided a couple of different increases or enhancements to unemployment benefits. The first is a $600 weekly benefit. That is in addition to the normal weekly state benefit, which at Missouri, the maximum is $320. So that is for leave through July 31st, 2020. And again, that's one piece of it. So again, a maximum of $920 a week unemployment benefits associated with unemployment under the CARES Act. In addition to that, it also creates this pandemic unemployment assistance program. This provides up to 39 weeks of assistance for those who either cannot get access to regular state unemployment insurance. So again, think maybe self-employed individuals, or those who've already exhausted state unemployment benefits. And this expanded benefit runs through December 31st, 2020. Now, if you were to go look at the Missouri Department of Labor website, these are still not up and running. Missouri Department of Labor has been awaiting Department of Labor guidance on these issues, which they did not previously have. The good news is effective, I believe, April 4th and April 5th, so Saturday and Sunday this weekend, this most recently completed weekend, the Department of Labor has issued guidance on these provisions. So I would hope, again, I don't know what time frame we would be looking at, but these will be up and running with the state of Missouri, hopefully sooner rather than later. So again, an increased dollar benefit amount through July 31st, as well as increased amount of time that assistance can be taken under unemployment insurance, and they've opened it up to more individuals than what they have in the past, and that provision runs through the end of the year. So again, more to come on that. That is on the way. Department of Labor has issued guidance associated with it, so hopefully the states will begin running this out relatively quickly. So with that, then I'll throw it back to Mark to discuss this idea of the employee retention credit benefit for keeping your employees on, even as business may be diminishing.
Thanks, Jeremy. The theme of Mark's middle part of this presentation is if you take the PPP, you don't get the extra benefits. And so continuing that theme, we have the employee retention credit. The idea of this credit was to provide a subsidy for employers who didn't qualify for the PPP or didn't take out a loan under the PPP. And this particular provision is a partial subsidy for businesses that have had a significant downturn in revenue, or due to statewide and local closures of certain businesses have had to shut their doors for some period of time. So again, your gateway into this provision is that you did not send in a PPP application to have an amount forgiven. If you do have an amount forgiven, it bars you from participation in this credit. But if you cannot take advantage of the PPP, then this provides a nice backstop. And again, it applies to businesses who have had more than a 50% downturn in revenue for a quarter measured relative to the previous quarter, or have had to shutter their doors. If we advance to the next slide, we'll see some relevant measurement periods here. So again, we have two situations where it applies across the top, and only situation one, where you were ordered to close in whole or part, applies to nonprofit organizations. So for our nonprofits who are listening, situation one would be your pathway in. So it would be for a nonprofit who doesn't qualify for PPP or who doesn't take advantage of PPP that comes in and takes these credits. The method of counting people is different depending on which situations you're in, and whose wages count for this credit are different depending on which situation you're in. For many employers with headcounts under 100 employees, we're going to count all wages paid to the employees during the closed or down quarter. How long does it continue? The idea of situation one is that it's probably only quarter two 2020. Good Lord willing, we'll have businesses up and running after Q2. And so we would just be looking at 1 quarter's potential credits here. For businesses who fall into situation 2, where there's been a significant downturn in their gross receipts, more than 50%, those businesses could potentially claim this over multiple quarters. For example, assume that our business is down 55% in Q2. And in Q3, we improved, but we only hit 75% of prior year performance on a gross receipts basis. This credit kicks in and stays kicked in until a business's gross receipts return to at least 80% of prior year. So again, this has the potential for businesses who are significantly affected by COVID and have a long-lasting impact. It could apply for multiple quarters to help subsidize wages paid to employees. But again, it's a 50% subsidy, and so we've prioritized the PPP over it. And so for most businesses, they'll choose the PPP over a chance at this employee retention credit. Let me kick it back to Jeremy, and he's going to start off with our first case study we'd like to run through with you all.
Thank you, Mark. Again, we'll be talking about 3 situations. The first one of which, let's assume the business continues to operate relatively normally. I use the word, emphasis on relative, and I think there are probably fewer businesses in this situation the further along that we get into this, particularly as we continue to see stay-at-home orders. But again, business continues to operate relatively normally. The main, motivation of the owner at this point is to try to figure out how best to take care of the business's employees. So if we move to the next slide, again, things that we've talked about previously, really the important things to consider under this, Families First Act, okay? If you have individuals that meet one of those requirements related to they have to be gone, they can't work or telework due to COVID-related reasons, that you are able to provide them, obviously you're required to provide them if they meet the requirements of sick leave and FMLA under this provision. Basically, this sets the floor. It guarantees employees impacted by this will have pay up to a certain amount, or at least up to a certain amount. I'm sorry, at least at an amount set equal to the floor within this bill. Okay? And the employer, to the extent they make payments under this, receive a refundable payroll tax credit associated with this. And again, there's nothing saying that an employer couldn't pay above this, but the tax credit is only available up to the ceiling, up to the maximums required in the bill. So that's, again, if employees have to be gone due to these reasons and they meet these requirements, your business is required to pay them under this, but you do receive refundable credits in the form of being able to withhold what you would otherwise pay over in payroll tax deposits. And to the extent those payroll tax deposits aren't large enough to fully meet the credit that you qualify for, it is a refundable credit. Now, in addition to that, we also have this PPP, right? The Payroll Protection Program, Paycheck Protection Program. As Mark has stated at various times throughout this, assuming you apply for this, all right, you are eligible for it, maybe a better way of saying it, assuming you're eligible for it and choose to go this route, in a lot of instances, this will be the better way to go. Okay? Again, these are loans that cover payroll predominantly. Again, the expectation with the SBA is that it covers it, 75% of it will be expended on payroll, but it can also cover rent, utilities, and mortgage interest. To the extent you pay it for those reasons within the 8 weeks, this is now forgivable. So why this ends up being a little bit more beneficial is because the Families First Act, in some instances, some of that leave, you're only required to pay it at 2/3. And in both situations, even if it's 100% of pay, there are caps on both. This would provide a funding mechanism up to 100% of pay that would eventually be reimbursed by the government. Again, you get the money up front in this case, so it basically is a grant. Again, assuming you meet all of the requirements. So being able to pay, a dollar's worth of wage, 100% versus, 66 2/3% would obviously be more beneficial to the employees, assuming you qualify. Now and we'll talk about this in a minute, we can use both of these together, but you can't double up on tax benefits associated with them. So with that, let's go ahead and move on to the next slide. The other option, as Mark pointed out just previous to this, or I guess, earlier on in the presentation, is this idea of a payroll tax deferral. Now, the deal with this is that there is no tax credit, there is no reduction in taxes eventually owed. Whatever you owe under this program, you will eventually pay, but it does allow you to help strengthen your cash position in the short term by holding on to amounts that you would have otherwise paid to the government in the form of payroll tax withholdings. What it does is it provides you the deferral, whatever would be owed from now until the end of 2020, half of it comes due at the end of 2021 and half of it comes due at the end of 2022. So for someone that for whatever reason may not qualify under the PPP, this at least gives them a way to hold on to some cash now, hopefully weather the storm, and then pay these amounts over to the government at some point in the future. Again, the beauty of this is that it does provide a current cash flow benefit, but where it's not as beneficial as the PPP is that the PPP is actually a grant. I mean, it is a funding mechanism. In this case, you're getting a present value benefit by holding on to the cash and deferring when you pay it, but you still have to pay these amounts over. And so that's why we would typically recommend, if you qualify, trying to access the PPP funds. So taking all of this, I guess, together, then let's take a look at the strategies. So if someone is required to take leave necessitated by COVID-19, there are tax credits available to employers to provide up to 2 weeks, well, 2 weeks of sick leave and up to 10 weeks of paid FMLA for COVID-related reasons, as we discussed earlier. In addition to that, businesses have the ability to access the PPP program, access loans that, again, if they spend them on the right things, typically wages, those will be partially or fully forgiven. If that loan is unavailable, then they can at least try to, strengthen their current cash situation by deferring payment of 2020 payroll taxes until 2021 and 2022. Here's the thing to keep in mind, though. Strategies 1 and 2 can be used together. You can both pay people leave, and it will be required to pay people leave if they meet the requirements under the Families First Act. You can do that and also access funds associated with the PPP loans. There is nothing stopping you from doing both. However, you are not able to double dip on the tax benefits. So to the extent you pay out leave under the Family First Act, the emergency sick leave or the FMLA plus, if you pay benefits out under that, to the extent you receive the payroll tax credit for providing those benefits, you cannot claim those wages as appropriate wages for when you look at amounts spent to get loan forgiveness under the PPP. You can do both, but you're only going to get the tax credits associated with the reimbursement under FFA. You cannot take those wages and use those as wages towards loan forgiveness under the PPP. In addition to that, items 2 and 3, or strategies 2 and 3, cannot be used together. If you have a PPP loan that is forgiven, you cannot take advantage of the payment deferral of payroll taxes in 2020. So that, in that case, is an either-or proposition. And like we said, the PPP loan probably provides the optimal situation. If for some reason you are unable to access the PPP program or the PPP loan, then take a look at deferring payment of taxes under that provision and at least try to strengthen your current cash position. With that, then I'll turn it over to Mark, who's going to discuss situation 2.
Mark is unmuted. We are good to go. Situation 2 is similar to situation 1, but instead of maintaining relatively normal profit and revenue numbers as we did in situation 1, we're looking at a situation under number 2 where the COVID crisis is putting us in a position where we might consider shuttering our operations for some period of time. The American Dental Association was pretty aggressive in putting out information on this type of a situation, anticipating a reduction in elective procedures done by dentist offices. And so that's one example of a type of industry that has wrestled with this question of, do we just close our doors, or what do we do? So if we'll advance to the next slide, we can think about some of the possible options. So one view would be that we close down the business for a temporary period of time. We furlough or lay off the employees, push them onto the unemployment rolls, allow them to qualify for the enhanced unemployment benefits, which in certain industries may provide a benefit that's greater than what the employees were being paid by the business. Now, an employee can't quit and jump onto the unemployment rolls, but if the business is the one making the decision, then that's a potential option that's out there. And so, as I said, it could provide the maximum compensation benefit to employees, especially those that make less than $920 a week in Missouri. But there are some risks involved with it. Business non-financial risks, or at least not immediately financial. So one potential is the impact on employee engagement and morale. The other is that your workforce that you've worked hard to have in place walks away from you and finds other opportunities in the meantime. So we think that communication with employees will be key from where we sit. Involving employees in those discussions, I think, has some benefits and the potential to protect against some of the negatives that could result. So again, we would have the employees out on unemployment benefits that Jeremy well described earlier in our presentation. But what about the Families First Act provisions of sick leave and FMLA expanded benefits? During a temporary shutdown or a permanent shutdown, those provisions are not going to provide any benefits to us. And so DOL and IRS came out and clarified that for people. That was one of the questions. One of the big questions about the sick leave and the FMLA was, what are the effective dates? And the answer was that it applies only to pay starting April 1st and later. And the other big question was, if we shut down, are we going to be on the hook for providing these at least 80 hours of paid leave under the emergency sick leave provision, and potentially longer to those who were stuck at home with kids who were out of school or daycare? And the answer is, if you shut down, you're not gonna get dinged with both of those items. So that's the shutdown idea. We advance to the next slide. Another option is we say, let's see if the PPP can keep us afloat. And an idea is that perhaps if we're going to try to weather the storm, we're not going to close our office. We're going to stay open and try to keep people on payroll. We're not going to push them onto the unemployment rolls. A possible idea would be that for those who are on FMLA or emergency paid leave would be broader. Paid FMLA would be limited to the one instance where you have a large percentage of your workforce who are staying at home to stay with kids who are out of school, and that workforce could not telework, as would be the case for our dental practice example. So in that instance, we might look to try to combine the two together. So what if we applied for the PPP and before we close on the loan, we pay out some people who have FMLA or emergency paid leave benefits to which they're entitled. So as Jeremy well described, we can't double dip, but if the PPP closing occurs after we've paid out the FMLA and the emergency sick leave benefits, then we will have the ability to pay those benefits out and take the credit, again, subject to our normal caps, 2/3 for people who are caring for others, full pay generally for people who are undergoing diagnosis or out with COVID. But again, that's only the 80-hour benefit for that situation. So we can pay our people under those provisions, get a tax credit that subsidizes it, and then close on the PPP loan, continue to pay our employees, and apply the payroll protection loan against the wages of our employees after we fully paid out, or mostly paid out, at least the sick leave portion of the Families First Act. So again, that's a possible combination of the two. We've had a lot of uncertainty coming into the last part of last week, whether it was going to be possible to do both. And what we think is the case is, based on current guidance from the SBA, there's no restriction on a business's ability to delay funding after they've been approved by not returning the paperwork quite as fast. And that might be a way to control the timing of loan closures. Be interested from any of the bankers on the call whether they think that works or have seen a less backdoor, more transparent way to just set the closing at a future date. So that's an idea there. If we can go to the next slide, a third possible approach is to try to combine the two together. And so we have seen some dental practices do this. And the idea would be that you would have a temporary closure. You would have employees receive unemployment benefits during that period of shutdown. You would take out a PPP loan, and we would try to time the closing of that PPP loan to correspond with the point in time the business anticipates reopening, hire the workforce back and be up and running. And we will have taken advantage of the rehire provision that Jeremy described earlier in the presentation to try to optimize the situation. Again, this is not without risk, and it really works best with in situations where the unemployment benefits aren't hurting employees, and in situations where there's a specialized workforce that is likely to return to you. If you're in a retail shop and somebody can go start working for Walmart right now and get extra hours working at Walmart, this idea is probably not for you. So let's flip. Actually, I'm gonna go ahead and flip it back to Jeremy for situation 3, and then we'll close out with a couple of comments and then some time for questions.
Yeah, Mark and Jeremy, I'm going to jump in here real quick. This is Sean.
Thanks.
And we are at 11:50. And I know we had promised that this webinar would last about an hour. We are going to stick around after we're concluded to answer questions. We have 26 in our queue right now in the Q&A and a couple in our chat. So I just want to let you know we are going to try to address as many of those questions as we can today. Some of them may be similar. If you've submitted them, it's likely some other folks have asked maybe a similar question. So we're going to do our best to go through those and combine and condense and get those things answered for you before we leave today. So appreciate your attentiveness, and we'll get to those as soon as we can. Thanks.
Yeah, thank you, Sean. If we could go to situation 3, then we'll cover this relatively quickly. And as Sean said, you know, we're all under quarantine, right? So surely we have time to discuss some of these questions after the fact. So yeah, hang with us. We'll try to get to as many questions as we can, even if it does go beyond the noon hour, or beyond noon. So situation 3, business has been forced to temporarily shut its doors, either due to a reduction in business or due to a mandated closure. So with this situation, we're really going to get in a lot of instances, it's going to be the same considerations that Mark well described. So option 1, if you still have employees working, you know, you haven't completely shut your doors and you have some employees working, you could pay those employees under the business's own sick leave or family leave policy, or even if you have individuals that aren't working, you could choose to pay them under a sick leave or family and medical leave policy. But as Mark mentioned earlier, in the situation where you have shut your doors, where the business is not operating, or you've sent people home because of a reduction in business, those situations are not eligible for the Families First Act credit. So a business can still provide leave, but if you've shut your doors or you've had to send people home because of a lack of work, we've received guidance from Department of Labor that those individuals would not, this doesn't qualify as leave under that program. In other words, the employer doesn't have to provide the leave, either the emergency sick leave or FMLA, and therefore they are not eligible for the tax credits associated with it. And another issue with providing that type of leave is it would also preclude the employees from being eligible for the expanded unemployment. So it may be that the best situation in that case is to temporarily lay off the employees to allow them access to the expanded unemployment benefits, subject to all of those risks that Mark so well described. Again, in some industries, this is going to work better than others, depending on what it may do to employee morale and how easily those employees may be able to find employment in other businesses. And again, the likelihood that they may not be available when you're ready to start the business back up. In addition to that, the PPP forgivable loan then still remains maybe your best alternative. You can access those loans, and you know, if necessary, if the bank is willing to work with you on this on a close, as Mark just described, one option would be to time the close of that loan to be when the business is ready to be up and running again. So your employees take advantage of the unemployment benefits up until that time. About the time you're ready to reopen your doors, you close on one of these PPP loans that then gives you the funding to carry on. If for some reason that's not an option, or you've already closed on the PPP loan, you can still use those loans to rehire individuals and to go ahead and pay them for the work they are doing, or frankly, just to be on call. Okay? To the extent that you want those loans to be forgiven, about the only option you have is to use them to pay wages during the 8 weeks after you have the loan. So that's why the timing of it is key. But if you're not able to do that, you know, if your doors are still shut, then the only way you're going to get forgiveness on that loan is to use it to pay your employees now. And then the last bullet point is consistent with that. You know, the other option is to lay the employees, if you're not forced to close, you know, you could also lay the employees off for a period of time, allow them to draw the enhanced unemployment. You could then rehire them and apply for a PPP loan. But in both situations, well, I guess in this situation where you're not rehiring them until later, I guess in any situation when you do that, you have to be mindful though of bringing them back by the June 30th rehire date. So those are just a few things we want to look at associated with that. So basically, if your business has been forced to shut down, you can either continue to allow the employees to claim enhanced unemployment benefits, or you can utilize a PPP loan, which is a forgivable loan in order to pay them for the work that, in order to pay your employees. Now you can use these together, as Mark has mentioned, but you have to be mindful of, you know, you can't take them at the same time, but you could of course bring the employees back and pay them with PPP loan proceeds. The only thing to be mindful of, if you were trying to walk the tightrope and utilize both of these, So utilize unemployment benefits up to a point, and then bring your employees back, open your doors, and pay them under the PPP loan. You have to bring those employees back by June 30th of 2020. Otherwise, the fact that the employees are out and in your full-time equivalent employee number is less than what it was previously, that will limit your ability to get a forgivable loan. So that's situation 3 in a nutshell. So overall, I guess if we can try to kind of put a bow on these situations, the PPP program is probably going to be the one most people look at first, assuming your business qualifies. The situations where it will not work well is if you have a business with little to no payroll. In that case, the program is probably not as attractive. This, however, though, if you take loan proceeds under the PPP and look to get loan forgiveness, that will typically preclude you from taking some of these other tax incentives. Okay? So for example, you won't be able to use the deferral of the payroll taxes, or you may not be able to take advantage, or you won't be able to take advantage of the employee retention credit. But that's okay, because in that case, that's only a 50% credit. It only covers at most 50% of an employee's wages up to $5,000 per quarter per employee. The PPP program will allow you to pay 100% of your employees' wages via what effectively becomes a government grant. Now, what we would like to be able to do in the most optimal situation is to access the PPP funds, but defer the origination of those loans until the point in time where the business is operational at close to full capacity. And again, I think this is something where it'll be important to work with your banks. We think there may be a way to do this. So what that could allow someone to do is either allow a maximization of those payroll tax credits under the sick leave policy, the Families First Act and the emergency sick leave, or the enhanced FMLA, or to allow, employees to take advantage of the expanded unemployment benefits prior to accessing the PPP funds. Now, for those that aren't eligible for the PPP, there are other options available to them, as Mark described. Work with your banks to try to get better, see what they will do during this period of time to sort of modify maybe the terms of existing agreements to help you, firm up your cash flow and enhance your cash flow, at least in the short term. In addition to that, there's also the emergency disaster loans, under the SBA that businesses that are available to businesses, as well as some of these payroll tax credits or payroll tax deferrals that we mentioned that would provide some cash flow benefit. They would provide some tax credit as well as potentially providing a deferral of when you make those payments. Enhanced unemployment benefits are a safety net. Again, those are available with the right messaging and right employee base. They may help you in a situation where you've had to temporarily, lay off or furlough your employees. And if you use that in combination, you may get to an optimal outcome, from a cash flow standpoint by pairing that with the PPP loans, assuming the timing works. And then finally, and we will make these slides available, I believe, on our website. I don't think I'm misspeaking on that. I know we've received some questions on that. We're only focusing on those tools where really there is a cost-benefit analysis or a choice between the strategies or tools. There are other items that we'll mention in these slides that we're really not going to get to today that we think are applicable to all businesses. And so we would advise, use of those as well, in addition to these other strategies. So with that, I think we can just take a look at these on the next 2 slides, but I think it's probably in our best interest to go ahead and move on to questions. I think if everyone is okay with that.
I agree, Jeremy. I think if for people taking notes, write down deferral of tax payments until July.
Yep.
And new net operating loss rules that apply retroactively. And the third thing I'd say to write down is for people who own commercial property, write down QIP, also retroactive. And so those retroactive items might affect your timing on when you want to finalize 2019 returns and possible amending of 2018 returns. All right, on to questions we go.
Right.
Sean, have you already grouped these, or what is your thought?
I have not. There are some fairly consistent themes in there related to whether the PPP, how it's used with individual or independent contractors. There are some very kind of business specific questions in there too. So I would suggest maybe you guys just hit them one at a time, and you can see the ones that you've answered as you go down through there.
Yep. Sounds good. We're going to start with the first one because this may be the quickest answer. So the March 19th about insurance premiums. So the question is, I checked around March 19th about insurance premiums being paid using my HSA account, and at that time you could not. Has anyone heard if that's changed due to the COVID-19 crisis? Mark, do you have an answer for that? I don't know that. I know that has been.
Premiums has not been addressed yet.
Okay.
There is some expansion for COVID to include testing, to make clear that any testing that is paid out of pocket would qualify under HSAs and high deductible plans, but use of HSA dollars to cover premiums during this gap period, I think is a wish list item at this point.
Okay. Next one about these PPP loans. So there's two questions kind of related to this, and I bet this will hit on some later. So do we have to have our doors physically open to qualify for 7A loan and loan forgiveness? And can those proceeds be used retroactively? So the answer to that is your doors technically don't have to be open to get the PPP proceeds. In other words, your ability to get the loan is going to be based on payroll that was paid in 2019. The problem, though, is if your doors are closed and you are not paying your employees, mechanically, it's going to be impossible to get loan forgiveness associated with that, because the loan forgiveness hinges upon you paying wages during the 8-week period after you get that. So you've either got to you've got to bring the employees back and pay them wages under this provision in order to get loan forgiveness. So no, having the doors open having the doors closed doesn't kill it due to a technicality, but practically speaking, you're not going to be able to get the full loan forgiveness associated with that. And likewise, the loan proceeds have to be used during the 8-week period after the origination of the loan. So you can't apply that to dollars that were paid, to wages that were paid prior to you receiving the loan. So going down the list, does the PPP apply to self-employed individuals? It does, but we don't know what exactly that looks like yet. And Mark, jump in if I misspeak on this, but the self-employed individuals are meant to be included under this. I will be completely honest with you. Mark and I have probably looked over this bill, I don't know, goodness knows how many times. This is one of the worst written sections of this entire bill, of the entire act, I should say. It's been passed. It does apply to self-employed individuals, and the loans associated with self-employed individuals, independent contractors, those are to open up on April 10th. So we should be getting guidance on that. The short answer is yes. We don't necessarily know what exactly that looks like.
Jeremy, I might just tack on. I think there's been a lot of questions about this. We've had instances where people who own single member LLCs that for income tax purposes are considered sole proprietorships question. I have employees, but I'm a sole proprietorship. This is all the income's reported on my Schedule C of my individual income tax return. And so again, I think a thing to keep in mind and make sure is when we're filling out the SBA applications, we're speaking SBA language, not tax language. So just because something is reported for income tax purposes as a sole proprietorship does not make it so for for the SBA purposes. Similarly, the guidance that we're getting is that for partnerships and single member LLCs with employees, there may be a split application where you're applying for the business based on its employees' payroll and then applying separately to take into consideration the income of the owner or the partners in the partnership. And I know we had several questions on that sprinkled throughout as well.
All right, moving on, 2019 had exceptionally high wages and overtime. We're trying to utilize staff from all staff from discontinued services, which would lower overtime. Will this be held as part of the loan forgiveness, or can we document this as being part of the solution to keep employees working? I think, and correct me if, chat in a follow-up if I'm not answering this correctly. I think what I'm getting at is, look, the overtime wages paid in 2019 would definitely increase the amount of the loan calculation of the loan proceeds. Now, if you don't expect to have that same level of wages in 2020 during this period of time, it will impact your ability to get loan forgiveness. It is a strict mechanical calculation based upon amount you spend for these items, as well as FTEs, calculation of FTEs and whether or not somebody is under the wage requirement. Their wages have been significantly reduced. I'm not sure, at least of what I've seen, any sort of relief from that based upon a facts and circumstances situation. So if wages were higher, your loan was higher, you don't have enough wages in 2020 to fully offset it, you will have a portion of that loan that is non-forgivable.
Good, Jeremy. The next one I think we had was on partners in a partnership receiving through draws. Again, we're going to have some guidance hopefully this week for loan applications opening on Friday. I know last Friday, many of us had anxiety and we were making jokes about the speed at which the banks would be able to process the loans, and people were cracking jokes that the money was going to be all gone by noon. We didn't quite get that. I think we ate through $5 billion and change of the 349 billion and change allocated to this program on day one. I know a lot of the big banks, and there's a lot of headlines out there about the big banks that have struggled to do what our local banks have done a great job of doing, which is to stand the program up with almost no guidance and record time. So hopefully there's money set aside still this coming Friday, and if there's not, we don't want to bank on it, but all indications from the politicians is that they intend to go back and find more money to replenish the program if it runs out prematurely. So again, individuals, partners in a partnership, stay tuned.
Let's move to some of these in the chat just to hit these really quickly. So part-time employee who's missed work due to having COVID, time missed started on 3/19 prior to the bill taking effect. So yes, the family credit would not apply to them for the time that they're off prior to 4/1. Now the business could always provide leave, for these COVID related reasons prior to 4/1, but that leave that's paid by the employer will not be subject to the credit. And likewise, if you had a business that didn't previously pay for leave under these policies, for these type of events, for any time missed prior to April 1st, the business would not be required to provide it, and as such would not, even if they had provided it, would not get the credit. Independent contractors. Do you count independent contractors, guaranteed payment partners in the payroll cost and employee FTE count? I think this is somewhat of an open item. Well, the independent contractors, this is one of Mark's favorite portions of the guidance that we got. This will get him triggered. That is also one of the worst written parts of this act. So the guidance that we got late last week stated that you could not include payments to independent contractors as part of a business's payroll cost. However, if you looked at the definition of payroll cost a couple of pages later in the guidance, it said income income of, and payments to independent contractors. So they appear to not want you to be able to count them. And then a couple of pages later, it's written in such a way to imply that you can. So for now, I would assume payments to independent contractors do not count. Guaranteed payments to partners are an interesting situation. I don't know that we have definitive guidance on that. I know there is at least one bank who shall remain nameless, but I think they have indicated that they would count guaranteed payments to partners as wages subject to the PPP. Again, I don't know that we have definitive guidance on that. That may fall in that same bucket as payments to independent contractors. It doesn't quite seem the same, but either way, I think more guidance to come on that. Anything to add to that, Mark?
I just add there's a good article in Forbes this morning by a really prolific accounting writer who it's basically structured as a letter to Secretary Mnuchin saying you would do everyone a great service if you would agree to the following mechanics, because the banks have been coming up with their own forms to try to interpret this gibberish that came out through a very quick legislative process, and the gibberish that came out trying to interpret and clarify that legislation. And so the combined gibberish is confusing. It's being applied different ways by different lenders. And it's something that would benefit from a consistent answer. And so there's really two phases to these PPP loans. One is you get the money, which is based on 2.5 times your payroll cost. And the other is that you get forgiveness. And I think there's some anxiety that we're going to be kind of have an open checkbook for step one. And if the SBA looks more critically at step two, that people might have spent money that then needs to be repaid. Again, they're not really in a worse spot than they would have been if the amount had just been denied at the outset. But there is a lot of confusion on that question. I think that it is clear that neither of them count in the FTE measurement, Jeremy, based on what we've seen at least so far.
Agree with that.
But payroll costs, as that term of art is defined, is another story, and there's lots of confusion about that.
Yeah, that's a new term as it relates to this. It's not clearly defined. So moving down the chat, can PPP still work if the employees are still working most days, or is it to cover their actual days off? No, the PPP is to pay people typically to work. So if someone has to be off due to COVID-related reasons, you can receive tax benefits from that under the Families First Act. But the PPP is to cover their actual pay, non-leave pay is what it is designed to do.
And I think, as the examples indicated, Jeremy, the best application of it, if it fits, is to use the leave when the leave applies early, and then to try to tack the PPP on later when the business is fully up and running, the employees are being productive, and the payments can basically offset the cost of that payroll, that productive payroll, to help get the business compensated for some of the other ripple effects that this COVID crisis is having on businesses.
Yeah, good point. And the last comment in the chat, I think, is one that you just made, Mark. It's that, again, worst case, if you get the funds and salaries are down in 20, and some of it is not forgiven, or, you're no worse off than what you would have been before. But then it becomes mindful of, you've got the funds, you're just not required to pay them back. So again, no harm, no foul potentially. If the payroll costs are down and you had loans in excess of that, worst case, you have to pay those funds back.
Yeah. Okay. A couple of questions here I'll group together on the mechanics of the application. Where do you apply? For the types of SBA loans that we're talking about, the PPP program, those are administered through the banking system. So, and the banks, as a rule of thumb, are working through their existing customers first and newcomers second. And so the starting point is the bank at which you have an existing banking relationship. go there and they will help you through that process. And if you need help pulling together payroll information or summarizing it, pulling together documentation, accountants, lawyers, others can help. Similarly, there was a question on what if the application wasn't in on the date that we started. It's not a cliff. That wasn't a due date. That was a start to the program to stand it up. It's going to last as long as the money is there, and money is allocated on a first come, first served basis. So there's no comparison of business A is more distressed than business B, so we'll favor business A. It's based on when the financial institution got the application to the SBA in a suitable form. So that's why speed and timing is of the essence, and we're hopeful that our clients who qualify will be making applications if they haven't already over the weekend, over the next couple of days.
Trying to, so some of the, so as far as like what is included, let's group some of those together. So payroll includes reimbursement, commission, and talent. Is that covered by the PPP? Yeah, generally speaking, that's what I was looking for, is the definition of that. So compensation is salary, wage, commission, or similar, cash tips, payment for vacation, parental, family, medical, or sick leave, allowance for dismissal or separation, payment required for the provision of group health, healthcare benefits, including insurance premiums, the payment of any retirement benefit, and the payment of state or local tax assessed on the compensation of employees. So most type of wages, compensation, commissions, tips, all of that's going to be included. As it relates to, I saw a question related to health insurance premiums. To the extent the employer is paying premiums on behalf of the employee, that would qualify. Amounts that the employees are paying via withholding would not qualify. So it would exclude the employee's portion of the insurance premium and would only be the employer portion of the premium. Let's see. So I think that's that. Apply for deferral of payroll taxes. I'm not sure we have the mechanism for that yet either, although they come out with a notice, the IRS has, saying that they will, to the extent that you underpay your payroll taxes because you know you're going to be eligible for one of these credits, to the extent you actually are eligible for that credit, you get there will be no late payment penalties or interest associated with underpayment of tax deposits. So now again, if some of it, if you I guess if you misestimate that, there may be some penalty, but they're saying hold on to what you would have otherwise pay if you know you're going to be subject to credits, and we will not apply penalties and interest associated with underpayment.
For the question, for the person who asked that question, the IRS notice is 2020-22. That's 2020-22. It goes through the relief from penalty for failure to deposit employment taxes in the correct amount in anticipation of a deferral or a credit.
PPP loan. Yes, if you get one, right. So if you get loan with forgiveness and the closure is extended beyond the estimated 8 weeks, nothing's stopping you from your employees receiving the benefit of unemployment. That may push them past the expanded unemployment, deadline of July 31st. But yes, those two things can be used in combination. If you get the PPP loans, it precludes you at any point from either using the payroll tax deferral or the employee retention credit.
All right, next question was on the interaction of the PPP program, which we featured in our presentation, and another program through the SBA, which is the Economic Injury Disaster Loan program. The EIDL has more flexible uses of funds, but it's a true loan in all instances. There's no grant element to it, other than there's a $10,000 advance when you apply for it. The interaction between the two is that you can apply for a PPP loan and an EIDL loan, but they need to be for different purposes. And if you apply for both, the $10,000 advance is going to come out of the hide of the forgivable portion of the PPP. And so if a business applied for both, the PPP forgiveness, as we've described it in this presentation, is really the best quote unquote handout that's available through the combined programs. But the EIDL would have longer repayment terms. Like Jeremy, I can't remember if we mentioned it, but the PPP has a two-year maturity on any amounts not forgiven. Very low interest rate, 1%. But again, the idea is that it's a way to get people over what's viewed as hopefully a short-term hump and disruption in business operations, not something that's really part of their capital structure or need for kind of permanent liquidity in the business.
Yeah. The loan forgiveness question, I thought we might have hit on, but basically it's going to go through the banks, but that's probably, one of those areas we're working with advisors, working through that calculation, but that will be provided to the banks. And so that, I don't know what the mechanism is as far as reporting to SBA under that, but that we will be working through the banks for the loan forgiveness piece. At least that's my understanding, similar to how we worked through the loan piece with the banks.
Yes, Jeremy, I don't think the guidance is out yet on that process, and there's measurement issues that are going to come up with the rehire rule, and so there's going to be additional work that's needed on the back end to figure out who's going to, what documentation is going to need to be provided. But until it's a grant, it's a loan, so businesses need to be viewing it as a loan because legally that's what it is. And only when the relevant costs are justified on the back end does it become a grant.
Yeah. Sorry, I'm looking at John's question. Can employees apply? Yes, I think we covered that one. So they can apply. You can apply for your employees can apply for unemployment benefits after the PPP benefits are received. The only thing is stopping them from getting the expanded $600 a week is just the timing of it and whether or not that expands beyond July 31st.
Yep, and we have a question in here on mortgages, and so we're talking about mortgages on business real estate, not on personal residences. And I think that question may tie in with this question on self-employed individuals. When next week, when somebody takes out a PPP loan as a self-employed individual or a partner in a partnership, and who gets the loan? Is it the business or is it the individual? And if it's the individual, what are the relevant payroll costs? And what we're expecting to come out in the guidance is that the relevant payroll costs will be the earnings of the self-employed individual, likely without the need to prove that there was actually a diminution of the income of the individual. And so, in other words, for self-employed individuals, I don't think that spending the money is going to be a limiting factor to the extent that the loan amount is 2.5 times the average monthly net self-employment earnings of that employee. I'm sorry, of that self-employed individual. Jeremy, is that your read on it as well?
I believe so. Yeah. I mean, again, more to come on that. But I think that's right. On items not associated with the PPP, let's hit a couple of these. Sole owner of an LLC. Am I eligible for the PUA? I would presume the answer to that is yes. Again, Department of Labor just issued guidance to the states to allow them to administer that. More to come associated with how that applies to individuals that previously would not have applied, that this would not have applied to. And then the payroll tax deferral question, taxes with deferral of payroll taxes. I believe that includes all payroll taxes, not, I believe both employer and employee piece, correct? Anything that would otherwise be paid over is withheld and paid 50-50 between 2021 and 2022. Is that correct, Mark?
That's right. It's a short-term loan of those pieces. Again, it doesn't change the total amount due, as Jeremy well described. It changes the timing only.
Yeah.
All right, how about, we had a question from John on Family First Program addition to PPP, that the origins of these programs where PPP came from the CARES Act, which was passed a week and a half ago, feels like longer. And the Families First Act was passed about a week before. Families First Act set out the minimum leave and emergency sick leave and FMLA enhanced paid benefit subject to the credits. That's a separate program. Its only interaction with the PPP is that to the extent you paid amounts under the Families First Act, you can't count that payroll twice as an amount that's forgivable under the PPP. So, you know, the advice, if you qualify for the PPP, is apply now, get the money, and if there's a way to be creative in the timing of the closing, we can consider that, but let's not let great be the enemy of good.
Yeah.
Or good be the enemy of great, or whichever way I said it.
Self-rent, I don't know that we have an answer to that question. That's a good one. I've dealt with that with some clients that I've worked with. You know, I think the initial read was as long as the lease was in place prior to February 15, 2020, it should be okay. I believe that, you know, there are some requirements associated with that type of situation as it relates to the SBA generally. But I don't know in this specific situation if those still hold. You know, I mean, obviously the most conservative thing to do would be to, you know, hit the expenses without it. But, you know, my take on it is, and this may just be my opinion, that as long as those leases were pre-existing this, I don't think you'll have a problem using the funds to pay those. And Mark, do you have a read on that?
No, I think the only thing I'd layer onto that is it gets to the point that Wes chatted in, which is when it comes to taking out the loan, the only thing we care about is 2.5 times payroll cost. That's the amount of the loan you can get. The second question is what amount of the loan is forgivable or forgiven. And if you took out too much, more than was going to be forgivable at the outset, that's okay. The only impact that it could possibly have is some of our banking friends have said, well, we're not running normal underwriting on these loans. So if somebody's not going to have a big chunk of this not forgiven, we'd like to know about that going into it. So we've had a lot of clients who have shown that what they anticipate spent, you know, that the 2.5 times payroll costs they're claiming are in proportion to the amount that they anticipate actually spending and being forgiven. But, you know, worst case, you borrowed it for the related party rent and they come out with a rule that says related party rent doesn't qualify, and you've taken the rent payment and paid it from entity A to entity B, and worst case, you took out a loan that for an amount that has to be paid back, and you're in no worse spot than you'd been if you hadn't taken out, if you had excluded that amount from what you were requesting in the loan. So some of this, I think we're going to figure out after the fact.
Yeah. Looking at Mike's question, I think Mark, you kind of hit on this about payroll for a firm with staff of one. You know, this may be a situation where it gets split. In other words, you know, the business applies for the loan based upon the payroll, and then there may be a separate application process related to your self-employment income. Again, the fact that you're not a wage, you know, again, it may be a sole proprietorship, you may be a partner in partnership where you cannot draw a wage, but that should not necessarily preclude you from being able to take that, to get a loan based upon your income. Again, probably more to come on that as they work out all of the details related to how it works for self-employed individuals.
I was mentally trying to wrap up by 12:30, but we do still have a long list of questions here. Let's keep picking through them. I think we still have 110 on the line, and
if it makes you feel good, Mark, we're halfway through the questions. So anyway, sorry to interrupt. No, so paid sick leave and FMLA, yes, those can be used. There's nothing stopping. You have to provide the leave, and you can also access the PPP funds. You just can't count the wages that you receive a credit for as wages subject to forgiveness. Independent contractors, the IRS has said, nope, They don't want that to be included, although again, the wording later on in the notice states that payments to it would imply payments to independent contractors count, but they seem clear that they don't want payment to independent contractors to count as payroll.
Yeah, and I think the banks are are at least doing the due diligence on these loan applications. And so, I've seen banks that have a line that says amount paid to independent contractor on there still. So if it goes through the bank and the bank says yes, I think you get at least the advance of that included in your payroll costs, and then there's the potential that SBA kicks it out on the back end, and that becomes an amount that has to be paid back in the next couple of years.
Let's see, kind of similar to what I just talked about. So the FMLA, so let's say you use a PPP loan, you pay wages for 8 weeks, you're still paying under the FMLA program after the 8 weeks. Let's say it's the expanded FMLA. You wouldn't have counted those wages toward the loan forgiveness anyway. So no, there's no problem with continuing to pay FMLA leave under that. Again, you can do both at the same time. You just can't count the wages both for the FMLA credit and for the PPP loan forgiveness. The next one on employees, and I apologize, I've probably used the term full-time employees loosely. So this is on the radio station with 5 employees on staff. Again, what you're comparing is full-time equivalent employees, not necessarily full-time. It doesn't have to be full-time employees. So as long as your employment is consistent from last year to this year, you should be okay.
I think that's right, Jeremy. The tail end of the question include, it's a smaller group of employees, and there is a commission component of one of the employees' comp. And so I think the thing to watch out for there is a potential choice for the business owner to recognize extraordinary circumstances and go to more of an average comp number for some period of time for that particular employee, or if they do let the comp drop with the drop in production, then there's a risk that they will have watered down wages in a way that causes some of the loan to become due back.
How do we show hourly employees pay? I'm assuming that is for the loan, the PPP application. Again, you're just taking monthly payroll. You're looking at payroll each pay period, figuring out what average monthly payroll was, and that's it. And and multiplying that by 2.5.
Yeah, and one thing we haven't touched on is FMLA rules, paid family leave rules. Emergency sick leave rules, PPP rules, all leverage off of a different foundational base in the law. And so we have slightly different measurements for various of these concepts. So people who are close to some of these thresholds, there's some additional thinking that they may want to do on these numbers. But Jeremy, I think you hit the nail on the head that we're looking at monthly payroll for all bodies that are receiving W-2 wages for the PPP application.
Let's see, employee benefits.
So I think the questioner is concerned about, well, what happens when we push people to the unemployment rolls, and for a lot of them they're eligible for COBRA, and their costs for that's going to come out of the monthly. That's going to come out of the unemployment benefit out of the pocket of the employee as a general rule, subject to whatever your particular business's plan provides for separated employees.
Yeah, agreed on that. And looking at the next question, I think that's an interesting question, because is the employee eligible to take 80 hours sick leave if the work is available to them in a business that is deemed essential but is covered by the stay-at-home rule? My read on that is, if it is deemed essential, that is an exception to the stay-at-home rule. So unless that particular employee is under some personal quarantine for some reason, or is required to stay home because because they have to do it, because their school or daycare is closed, unless one of those individual situations occur, I don't think they would qualify for the 80 hours, even if they're under the stay-at-home rule, because the business is deemed to be essential. At least that's my kind of off-the-cuff take on that.
Yeah, Jeremy, and I know we've had this question before: is if the leave isn't required to be paid and we pay it anyway, do we get the credit? And we think the answer is no. There's certain medical groups that, and an exception that we didn't cover for our general tools discussion, where medical organizations that are essential are not subject to this paid leave requirement, sick leave requirement, or they have the ability to elect out. And we think if they do elect out, that they're going to elect out the tax credits potentially for their entire organization. Correct. Even though the election is potentially done on an employee by employee basis. So still some open questions on some of those nuances.
Yeah. Next question: no, the payroll is not retroactive. It's not a look back. So if you get, it's wages for the 8 weeks after the origination of the loan. So yeah, it could be. So it's after the actual date that the loan is approved.
After funding. Yeah.
After funding. Yeah. Thank you. Full-time employees calculated for the PPP. Again, the baseline is calculated. They give the baseline. I want to say it's January through June of 2019, I believe, is the baseline period. Again, it's full-time equivalent employees. So I assume number of hours divided by 2080 to get full-time equivalent. And then you do a similar calculation, and that is during the period with which you have the loan. So that's the 8 weeks after the funding of the loan. And so, if employees were laid off on or before April 1st, you can still rehire them by June 30th. So again, you could have everybody unemployed, rehire them by June 30th. You'd still qualify for loan forgiveness, but you won't have any wages that you'll have paid associated with it. So, you still won't get any forgiveness for that loan because you had no wages to pay. You'll have some associated with the rent and the like, but the SBA is, the expectation is, the requirement is that 75% of it has to be associated with salaries. And we do not have as far as the second part of that question, I think was about whether or not there's a chance for deferral. I think that option is open. Again, I think that's something I would work with your lender on as far as when you actually close on that loan in order to time it in the most effective way possible. The answer to the next question, yes. So if you get the PPP loan, you have full employment for the 8 weeks. And then after the loan, that's things continue on a downturn, you let people go, that will not count against you.
No clawback as things stand now.
Yeah.
The next one was on the definition of payroll costs. You could ask 10 accountants the definition, and you get slightly different nuances. I might direct Sarah to our webpage and have a more thorough listing there, but includes wages. Payroll taxes is something that's been a lot of discussion. We'll send out a link to the Forbes article that I discussed this morning that I think touches on all of these here.
The not-for-profits, Mark, do you know, are they covered under the expanded unemployment definition?
I believe they are. Yes.
Assume they are. Okay. The answer to the next one, no. It doesn't have to be the same employees. It's strictly going to be a full-time equivalent employee count, whether that's the same individual or somebody else that you've hired to take their place.
Sorry, for recording's sake, I'm not sure if the questions are visible to everybody.
Oh, that's a good point.
So if we terminate somebody and then rehire, if we terminate Sally and rehire Steve, is that a rehire? And it's on a full-time equivalent basis. And so, Jeremy, one thing I don't know is, June 30 is the magic date. I don't know, full-time equivalence generally implies some part-time, full-time measurement period. And so I'm not sure if we're going to get additional guidance on a measurement period to use to test for that June, if it's going to be, period started June 30, extending for some period of time. I think we'll expect some additional guidance on that measurements, but
I think so.
Equivalence is the key.
Yeah, because that's typically calculated throughout the period, but that June 30th kind of throws a wrench in that, and it's almost as if it's a cliff, so are they here right at, or are they not? But yeah, we're gonna have to get more guidance on that. So the question is, the business typically is treated as a 1099 independent contractor, but all employees are salaried. So that's is, in my opinion, I think that business, I mean, I guess I might need to know a little bit more about the ownership structure, but I think you would apply for it on behalf of the business associated with the wages of the individuals, the wages of the employees.
Yeah.
And again, now, if it is a sole proprietorship, maybe there's a if it's maybe there's a self-employed income piece of it. But I think there's definitely an application to be had by the business based upon the employee wages, employee salaries.
I agree, Jeremy. I think that's one where the definition of employee independent contractor gets a little bit squirrely in this, but
Yes.
An accounting firm receives a lot of 1099 MISCs from other companies where we are an outsourced part of their business. We're an independent contractor. But depending on how we're organized, if we're organized as an S corp and all of the shareholders earn wages, then it works just like any other business. The fact that the people, our clients, viewed us as an independent contractor doesn't really matter. That's just business revenue to us, and we're filing the PPP based on our payroll. If we're organized as a tax partnership, then we have kind of this hybrid split where again, we don't really care that we're considered to receive independent contractor income from our customers, but we'll have a piece that's based on our payroll and a piece based on the individual partners or sole proprietors being viewed as self-employed under the relevant tax rules.
Let's see. Sorry, I was looking at the next one. I have questions specifically related to the admin of emergency sick leave and FFA. I know our HR person has been, kind of in contact with others, maybe in the groups organizations we belong with. I think the Department of Labor website has been really good about getting frequently asked questions out there. I think first and foremost, what I would recommend you do associated with that is go to the DOL website, and they've been keeping a running list of questions. And I think that's at least a good start. And then I think if you belong to any industry organizations, reach out to them as well for that. But start with Department of Labor. Even for someone like me that is not necessarily in tune with the HR employee benefits side of it, it's easy to understand, and I think they hit on at least some of the main topics.
If you use the EIDL and the PPP, as long as you use the EIDL for payroll purposes, so as long as you didn't use the EIDL for payroll purposes and instead use it for general business expenses, it would be forgivable. Forgivable, no. Eligible, yes. So the EIDL can work in that situation, but the EIDL is not a forgivable loan program.
Correct.
The next one was on it. Go ahead.
No, I was going to say, and you mentioned this earlier. I'm sorry to interrupt. You can't use them for the same purposes. So, yeah, you would be ineligible for the PPP if you use the disaster loans, the EIDL, for payroll cost, for example.
That's right. Interest rates have been confusing. There's a maximum interest rate in the bill and a maximum repayment period in the act. Maximum repayment is 10 years. Maximum interest rate is 4%. Neither of those are what they picked. It's the same terms for all borrowers. At one point in time, that was advertised at 0.5% in some literature. Final answer on that is it's 1% repayable in 2 years if not forgiven or repaid sooner.
Yep. Jana, thanks for staying with us. On your question, there's been no guidance yet that states otherwise, but it doesn't appear that they're going to make any differentiation between what caused the reduction in FTEs. If it's natural attrition, it is what it is. If average FTEs during that 8-week period are less than, or if you have fewer FTEs during that 8-week period than what you did during the baseline, that will cause some of that loan to be non-forgivable, and that shouldn't matter. Again, based on guidance we have or lack of guidance, there's nothing that states that there's going to be it doesn't matter the timing of that attrition. Repay, I think there was a question about the repay. I think, Mark, you touched on that. 2 years. I'm assuming that's what that's getting at, 2 years at 0.5%.
Yeah, I think that's right. Next question is, are scheduled monthly repayments of personal loans to the company eligible for PPP reimbursement? And if it's a mortgage loan, I think potentially yes. If it's an unsecured general loan, Jeremy, I think we said that the interest component is an eligible use, but will not trigger forgiveness. Is that your read?
That is correct. It's one of those strange situations where interest on non-mortgage loans, you are allowed to pay those with PPP funds. So, whenever you certify in the application that you're going to use them for X, Y, and Z reasons, that's one of the reasons you can use them for. But interest paid on non-mortgage loans is not subject to loan forgiveness. So you're correct, Mark.
And we have 70 people that have stuck with us through 45 minutes of question and answer. So you guys are troopers and get the Endurance Award. Last couple of questions. We are an employer with fewer than 50 employees. Is extended FMLA even an issue for our size company? The 50 employee threshold is an exception to the expanded unemployment FMLA benefits that we talked about that were part of the Family First Act. We did not harp on the 50 employee requirement because we don't think it's that applicable for a lot of businesses. It requires a showing that the going concern status, the ability of the business to continue, will be undermined if we're forced to pay out 2 weeks of paid family leave or FMLA benefits at 2/3 to a group of employees that are caring for their kids while out of school or out of daycare. And in my mind, that's a difficult case to make when there's a federal income tax credit covering exactly what they're requiring those businesses to provide.
Yeah.
So we did not harp on that, but general rule, under 50 employees, we still have to think about this as being a requirement we're subject to.
We're down to our last question, and I feel bad, Mark, because this one's outside. This may be outside of your and my wheelhouse. I hate to end on that type of question. Will the forgiven loan be considered a grant subject to single audit requirements?
I think the answer is probably no. But that is just a wild guess on my part.
Yeah, my off the cuff is no as well. I would suggest that's an anonymous attendee. Send that question to our WK boss or general WK. I don't know if our emails will be on we're on the slides. Send that question to us, and we will have somebody get you guys. Yeah, there we go. Assuming you're still there, send that question to us. We will forward it on to someone for whom that is not a wild guess.
All right, to the 68 who hung with us, thank you so much, and hope this was helpful. Again, follow-up questions, send them our way, and we'll make sure someone from our team gets back with you and figures out where to best help you.
And Mark, I'll close it out here. We will have the slides from today's presentation as well as a recording of today's presentation available on our website later today. We are going to organize our website in such a way that you'll be able to easily find the webinar information there. As Jeremy just mentioned, if you would like to send any follow-up questions to us, you can do that. Keep it simple at information@williamskeepers.com. And we will forward those on to the correct folks and get those questions answered for you. But to Mark and Jeremy, thank you so much for hanging with us. This turned into a longer commitment for you than what we'd anticipated, but I think the information that we shared was fantastic. And to all of our participants who hung with us, again, thank you for being with us as well. And I'll thank a behind the scenes person that rounds out this team of four who brought this to you today. It's Jennifer Backus, our Director of Marketing, is behind the scenes here. So we certainly appreciate Jennifer too. So if you have any additional questions, as I mentioned, please forward them to us at information@williamskeepers.com, and we'll get back to you as soon as we can. So in the meantime, please stay safe, and best wishes to you and your families.